Hello and welcome to today's webinar, Thinking of Selling Your Business. My name is Sharon Adey and I'll be your moderator. Thank you for joining this session where we aim to provide you with useful hints and tips that will assist you with selling your business when the time is right. Before we start, I have a few housekeeping items to cover. First, we'd love to hear from you during today's presentations. If you have a question for our speakers, please feel free to send it through the Q&A tab at the top right of your screen. This can be submitted anonymously if you would prefer to do so. We'll be answering questions at the end of the session, but if we don't get to your question during today's webinar, we will be sure to follow up afterwards. Also, just to let you know, today's webinar will be available on the Jerome's website after the live session. So, without further ado, I'd like to kick things off by welcoming Paul Heaven from Jerome's Corporate Finance. Paul, over to you.
Hi everybody, Paul Heaven here, Jerome's Corporate Finance. I think as Sharon said, we've got quite a lot of fascinating content to run through today. I'm going to run through the process. I'm then going to invite Nick Wright, also of Jerome's, to talk about the tax implications, both pre and post deal planning. Bart Dalton, one of our friends from the legal sector, from Portfolio Legal's, then going to step in, and Bart's going to talk us through some of the legal implications, and then we're going to finish off with, last but not least, we're going to have Nick Hathaway talk about the wealth management implications and what hopefully will be the planning of the ill-gotten gains from the process. A lot of content to get through and quite a tight time scale, so you'll forgive me if I don't literally read from slide to slide. So I'll cover the main content. The slides will be available online later, and hopefully you'll pick up the gist as we run through. So I'm Paul Heaven. I'm the director of Jerome's Corporate Finance. Some people on the briefing may know me from my previous incarnation as the owner manager of Blue Sky Corporate Finance. We merged with Jerome's last October to form Jerome's Corporate Finance, and I have just over 20 years experience in corporate finance activity, both sell, buy and fundraising, and literally hundreds of transactions. So we're going to, as I say, run through some of the kind of key aspects of the planning of the whole kind of selling your business cycle. Specifically, we're going to run through the process, the tax, legal advice, and then the wealth management considerations. So in terms of almost, if you like, the transaction or pre-planning of the transaction, it's probably worth noting that the transaction itself, the process that I'm going to run you through, probably takes between maybe 6 months and sometimes as long as 12. Rarely takes less than 6, and it's not uncommon for a buyer to be looking for you to potentially stay on with the business for anything upwards of maybe a year or two after the transaction has ended, and it's equally not uncommon that we get involved in some preparation of the business from the point of view of getting the business into the right shape for exit. So what does that all tell us? Well, it tells us that in terms of your thinking around this, if the driver to the exit is when do I step down or manage to step away or retire from the business, then it's a transaction that you really need to be thinking about probably not less than 3 years in advance of when you want that to happen, and maybe as much as 4 years if we need to be doing any clever tax planning along the way. So it's, I would say this, wouldn't I, but it's genuinely never too early to start thinking about planning towards that exit stage. Now, the next slide is unashamedly quite busy, and like I say, the slides will be shared with you, but we'll deal with maybe making available copies. You can talk to us offline about some of the detail. I'm not going to pick off, you'll be relieved to hear, I'm not going to pick off every one of these boxes, but I guess it's important just to emphasize the point that there is a process. Now, that may sound like a statement of the obvious, but a lot of sales mandates that we get involved in are actually triggered by somebody approaching a business owner. Maybe they haven't thought about exit yet. They get approached by a competitor or a customer or a supplier who wants to talk to them about, have you ever thought about selling your business? Well, if you stop and think about it, you most likely wouldn't sell your car to somebody who tapped you on the shoulder down the pub, and you most definitely wouldn't sell your house. And in many cases, the business asset that you own is singly the most valuable asset you have in your asset portfolio. So you won't be surprised to know that that's not really the ideal way going about securing maximum value. And even if you are tapped on the shoulder, I just want to share with you an experience that we had a couple of years back, actually almost 5 years back now, where we sold a business on the Birmingham Business Park at Solihull, where it was a media business, computer software media business, that was approached by one of its customers, the Mannheim Group in America, to be interested, were they interested in selling their business. And the provisional terms indicated by the buyer in that instance were, and I'm being a little unfair here because it was a complicated structure, but were probably worth about 2 million quid. And we went into a process there, a formal sales mandate process, and the eventual buyer was in fact the company that first approached the business owner. It was indeed the Mannheim Group, but they ended up paying almost 4 million for the company. So, this is a process about maximizing value. Now, like I say, there's a lot to get through, so I'm going to pick off some of the key aspects. So those 4 pillars that you saw on the process diagram, the first of those is the planning phase, and this is where we really get into quite a lot of research of comparable transactions, research of who the potential buyers might be, and we work towards getting the structure of the company right. Now, this is the stage where if there are going to be any complicated aspects, like maybe a demerger of some activity prior to the transaction completing, this is where we're going to pick that up. We're going to look at it, plan it, and build it into the timetable. The slides there also refer to an A, B, and a C list. And just to cover that off briefly, typically we draw up a list of potential buyers and categorize them into A, B, or C. A are those organizations, companies, or even individuals that we know are likely to be interested in buying your business. B are those that are in a kind of tangential industry, an industry that it's closely associated with yours, but maybe not direct competitors, less likely to buy, but they might be interested if they're looking to do some kind of, horizontal integration. And the C list is typically financial buyers. So these are financial institutions that are known to be acquisitive, but it can also be other kind of corporate finance boutiques like ourselves who are maybe acting for a buyer or a range of buyers that have a particular criterion. So again, we can do more to explain that list when we get to that point, but it's an important part of the process is to draw up. And by the way, this is done open and collaboratively with our clients, so it's an open and transparent process. And it's very much a collaborative process. So drawing together the list of who might be interested in buying the business is a joint exercise. So this is all about prepping the business ready for sale, make sure that the process, timetable, valuation are all in a place where everybody understands what that's likely to be. And that will hopefully then lead to no surprises during the process. But there are a lot of things we can do here to prepare the business ready for sale. We then really move on to the next stage of the process, which I've called here engagement with potential buyers. The key steps in this stage of the process is where we draw together the information memorandum. And if I pause there for a moment, the information memorandum is a document that is meant to be a brochure on the company, but it's not entirely a kind of positive reflection. We'll see later on during phase 4 that there is going to be due diligence done. So if there are, I mean, clearly what we're trying to do here is tease out the things that we think will interest buyers. So how good the product is, how sticky the customers are, the financial performance of the company, its brilliant management and staff structure and so forth. But it isn't just exclusively a positive document. If there are risks associated with the business, if there are long-term lease commitments or property commitments, these will make their way into the IM, not because it's meant to be in any way a kind of negative, it's not that kind of document, but it is, there's no point in waiting to due diligence to depart any negative dimensions to the business. So it's important that we give a balanced reflection. But having produced the IM and agreed that with you, what we'll then do, and it seems a bit counter-logical, but we'll actually draw some of the key features from that document into what we call the taster letter. And it is still called a letter, even though it's delivered electronically these days most commonly, and we'll use the taster letter without identifying who the company is that we're selling as a means to solicit the initial interest in the company. And that's important because it deals with the issue of not wanting to provide any competitively threatening information to potential buyers until they've executed the confidentiality agreement. And just on that point, I know a lot of people will be nervous about their staff or their customers finding out about the sales process going on. Nobody without signing the confidentiality agreement, and the confidentiality agreement is very draconian on the issue of how that issue is handled. So it's in the 20 years that I've been doing this, I can promise you that I've never seen a situation where that information has leaked to either customers or staff during the process. So that's very important. And then in terms of how do we reach out to them, again, you won't be surprised to know that we use all manner and means of electronic communication these days. So, we'll buy email lists, we will, buy email contact details, we'll use LinkedIn, we'll use, we'll use any our contemporaries and our fellow professionals that we work with. I mean, many of you will know that Jerome's is part of the Russell Bedford network, and that's a means by which we can reach out to pretty much any buyer on around the globe, and we commonly use those as means of reaching out to potential buyers. So having got the potential interested parties interested, got them to sign a confidentiality undertaking, we'll then be in a situation where we can begin to engage, provide them with the IM, and move to the next stage of the process. And again, the next stage of the process is to start to share data with them, answer questions, set up the meetings with the management team. I often get asked at this stage is, do we run an auction process? Well, we kind of do, but not in any kind of, hammer and gavel sense of that word. But it is all about using the indications of interest from the shortlisted potential buyers as a means of teasing better terms out of the other interested parties. And again, just very briefly, I'll talk to you about a company we sold the year before last, where we had a lot of interest. It was a software company that we'd valued in the range of 10 to 12 million. And all of the offers came in at around that level. But it very quickly narrowed down to a short list of 3 potential buyers, very large UK PLC, an even larger, a very large Chinese company, and a comparable American publicly quoted company, and without ever conducting an auction as such, the process of one another outbidding each other quickly gained momentum. And although the opening offers for that company were all in the 10 to 12 million range, we ended up actually closing that transaction out at just a little over 20 million. So there is a process here by which we unashamedly use the offers of each other to draw to that selected buyer. And the selected buyer, by the way, may not necessarily be the one who offers the highest price. It may be some other aspect of the terms, how quickly they're going to pay, elements of deferred consideration or contingent consideration that may help to determine who the preferred buyer is. But clearly it's you guys, it's the business owners that determine who the preferred buyer is. And then the fourth stage of the process is to manage the completion process. Now that involves due diligence carried out by the would-be buyer. That scope will be almost certainly financial and legal, but can extend into other areas of due diligence. And our job at that stage becomes one of managing the project, really, project management. In fact, one of my clients recently called me Captain Timetable. So it's all about trying to drive that process through to avoid deal fatigue. By then there's a lot of information, and I can't oversell the point here that at this stage it's useful to be working with a partner that understands what the the buyer's going to be looking for during that due diligence process. So there's an awful lot of this work can be done prepping that business prepping that information prior to the completion stage taking place and managing that through. So those are the key, and I know it's a high level, forgive me, but I have limited time. So those are the key elements of the process. Key message I want you to take away is that there is a process. It is well established and formalized. That's me reminding myself, by the way, that I've run out of time. We'll move, without further ado, we'll move on to Nick Wright to talk about some of the tax implications of the deal. Nick.
Right, thanks, Paul. Thank you. My name is Nick Wright. I'm Corporate Tax Manager here at Jerams. And as Paul said, I'm just going to run through some of the tax implications and what we need to think about prior to selling a business. And obviously there is a lot to think about, so I'll kind of do a very quick run through of everything. But obviously any questions at the end, just give me a shout on that. So the first thing to think about is whether a potential buyer is looking to purchase the shares in a company or whether they're looking just to acquire the trade and assets. And there's quite significant difference both from the tax implications for the company and the tax implications for the shareholders themselves. So just looking at the sale of shares to begin with, this one's a lot more straightforward. Obviously, the potential buyer comes along, they make the offer, in the consideration maybe in various forms, but effectively everything's taxed directly on the shareholder. Shareholder makes capital gain. Ordinarily that would be taxed at 20%, except in situations where they're either a basic rate taxpayer, the basic rate band is only taxed at 10%, but the remainder at 20%, or if they can qualify for business asset disposal relief, which we'll come on to as well. The types of consideration that you might see from a prospective buyer is the most simple form would be in the form of cash. That's quite straightforward. Everything's taxable at the date of disposal, and obviously all the cash after the tax has been paid is retained by the shareholder. Other potential considerations, though, the buyer might offer some shares in their own company, or they might offer loan notes, which may be redeemed over a certain period of time, 3 years, 5 years. Automatically, the tax treatment of those, the shares or the loan notes, would be that the share-for-share exchange treatment applies, which effectively means there's no immediate gain. The gain is only taxable when you come to sell the shares or redeem the loan notes in the future. However, what that does mean is you might not qualify for business asset disposal relief, potentially therefore it will double your tax charge from 10% to 20%. So there is an election that can be made to disapply those rules and therefore qualify for the flat rate 10% business asset disposal relief. The other type of consideration that might be made for your existing shares would be through an earn-out, which is quite common, certainly if the future prospects of the business aren't 100% certain. And how that earnout is taxed depends on whether they can ascertain the consideration and the amount of the consideration at the date of disposal, or whether it's perhaps contingent on something like future turnover or future gross profits. So if it's ascertainable consideration, you can quantify it now. It might be, say, £500,000 12 months down the line, as long as we hit a certain turnover or certain gross profit. That's all taxable immediately, regardless of the fact that you're not receiving the funds for another 12 months. If it's unascertainable consideration, similarly, it's taxed all up front. You have to value the future consideration as best as you can. That consideration effectively becomes a chosen action. So that's an intangible asset. And when you receive the future consideration, it becomes a disposal of that intangible asset, meaning whatever you receive is the proceeds, and whatever you've already paid tax on becomes the cost that you can deduct from those proceeds in the future. So there's a variety of different kinds of consideration and certainly different tax treatments, and certainly with earnouts, obviously you're not receiving necessarily the cash straight away, but you are paying the tax on it straight away. So that's certainly something to consider in terms of how much you receive in cash and compared to how much you're receiving in the earnouts to fund the tax liability. So just moving on then to the next slide in the sale of assets. So this would be where the buyer comes along. They don't want to buy the shares in the company. Maybe they're worried that there's some liabilities in the company that they don't want to take on. So instead, they offer for the trade and assets of the company. What that means is that it's the company selling those items. So if they've got land and buildings or goodwill being is only capital if it was acquired pre-2002, that would create chargeable gains for the company. If you're selling stock, potentially you've got profits on that stock, depending on how much you value that in the sales agreement, and you might have balancing adjustments on capital allowances as well. Now, the downside to that, obviously, is that the funds and the cash is paid to the company, and the tax is paid in the company. You then need to take the cash out of the company. A variety of ways you could do that, depending on what you're actually looking to do in the future. You might choose to reinvest. You could either, if you wanted to start up in a different business, you could use that cash in the same company, or you might draw that down via dividends, either straight away or in the future. But obviously, dividends taxable to income tax rates, which are significantly higher than capital gains tax rates. The best option to withdraw that cash as a capital distribution is to do a formal liquidation of the company. All liquidations allow for capital distributions. Any distributions during a liquidation are only income tax liable if the targeted anti-avoidance rules apply, which is certainly something you need to consider. They're quite complex, but effectively the targeted anti-avoidance rules say if you carry on a similar business, whether that be as a director of a company, as a sole trader, etc., and you do that within 2 years of the liquidation, HMRC can go back and consider whether actually that capital distribution should be converted to an income distribution, which obviously, again, can change something that maybe you've taxed at 10%, so anything up to 38.1% tax charge. So certainly something to be aware of, but it is an anti-avoidance rule, so the HMRC have to be able to show that you are doing something for tax avoidance rather than for commercial reasons. So if I could have the next slide, Paul, I'll move on to just a short example and a very basic example of perhaps what the difference could be for selling your shares and the company selling the assets instead and liquidating it. So if you're selling the shares, the buyer comes along, they acquire, this is a trading company worth £1 million, husband and wife earning 50-50. So the buyer comes along, buys the shares of the husband and wife, Tradeco becomes 100% owned by Buyco, and that's quite straightforward. So £1 million sale, husband and wife each get 500,000, taxable ideally at 10%, provided the business asset disposal relief conditions apply, and they'll retain in total £900,000 between them. just briefly, that I've assumed no annual exemption there, just to simplify the figures slightly, but everyone does get at the moment 12,300 capital gains annual exemption, so any gains on the first 12,300 would be exempt anyway. Moving on to a sale of trade and assets, as I said before, the company has to sell the assets first and potentially pay tax on that. So if they sell the trade and assets for £1 million, potentially they've got a tax charge at 19% of 190,000. So there's only cash left in the company of 810,000. Obviously, that assumes there's no base cost whatsoever. So if you've got buildings in there that you've paid for previously, you'll have a base cost on that. You'll have cost of stock if you've got stock in there. But certainly, if you're mainly selling goodwill, you might not have any base cost, and therefore the full amount being taxable to corporation tax. If you then liquidate the company and take all the funds out as a capital distribution, you're distributing 810,000 between the husband and wife, paying tax at 10% ideally again, and you're only retaining 729,000. So the next slide shows a comparison between the two and potentially how drastic it could be. So in a sale of shares, we said in the example, they're receiving 900,000 after tax, whereas in this example, a sale of the trade and assets and then liquidating the company, you're only receiving 729, so a potential difference of £171,000. Again, this will depend on whether the shares themselves have any base costs. So again, we've assumed that if you've got 100 shares in the company, that your base cost is your par value of £1 per share, for instance. It might be the case that actually you acquired these, it was an inheritance, and maybe you've got probate value, or you've acquired them from another individual, in which case you would have a base cost to reduce the gain. But just as a very rough example, that shows kind of the differences that you need to be thinking about in terms of if someone only does want to buy the trade and assets, then you need to consider sort of adjusting the purchase price to reflect your additional tax liability. So that gives you an example of the differences between the two. So if we move on now to business asset disposal relief, which I've already touched on a few times. This is what used to be called up until the budget of this year, entrepreneurs relief. The main things that were changed, for some reason they decided to rename it, and the other significant change was that they reduced the lifetime allowance from 10 million down to 1 million. So only gains up to £1 million for each individual will be taxable. And within business asset disposal relief, everything else is taxable at normal rates, so that would be 20% basically. So the conditions that you need to meet in order to qualify in a sale of shares is that for at least 2 years up to the date of disposal, the company needs to be a personal company. That means you need to have at least 5% of the ordinary share capital. The company needs to be a trading company or holding company of a trading group. HMRC consider anything more than 20% of the assets, income, management time looked at in the round. As if that's any more than 20% is an investment activity, they consider the company is not a trading company, and therefore business asset disposal relief doesn't apply. And the final one is that you need to be an employee or officer, so a director or company secretary of a company or a company within the group for the entire period up to the entire 2-year period or longer. The one area that could be caught out there is if you, for instance, resigned a day before the sale, you're not actually a director or employee up to the date of the sale. So you need to make sure that on the date of the sale, you are still an employee or director. I'll just run through this one very quickly because I'm conscious of time, but the next slide shows you a sale of trade and assets. Similar conditions, personal company owning 5%, trading company, employee or officer, but there is a slight leniency here, whereas obviously as soon as the company sells its trade and assets and it's only got cash in, it's no longer a trading company. So the conditions are slightly relaxed in that case, where if, as long as up to the date the company ceases to trade, all the conditions are met, and you dispose of the shares within 3 years, so effectively the buyer comes along, buys the trade and assets, and then you liquidate it within 3 years, you can still qualify for business asset disposal relief on the cash proceeds. So moving on to the next slide, there's just a few planning opportunities worth mentioning. Obviously, apart from making sure you do meet those conditions, potentially you could transfer some shares to a spouse if you haven't done so already. Transfers to spouses are no gain, no loss at capital gains tax. And as long as, again, the spouse meets those conditions for the 2-year period, then business asset disposal relief can be split between the two of you. That's again useful if the company sold for more than £1 million, then you've both got a lifetime limit of £1 million. But it's important to make sure that you do meet the 2-year holding period rules. And finally, just moving on to a few other considerations on the final slide. Again, very quickly as we're running out of time, but just a few things to touch on. These are quite complex areas which we could spend a lot more time on, but just to give you an idea of what you could do if the company is not necessarily in a position that you'd like to sell it. If, for instance, you've got 2 trades in there, if you've got assets in the company that you don't necessarily want to sell, you could look at doing a demerger. You're looking at sort of 3 to 6 months typically to actually complete on a demerger, including getting clearance from HMRC. But they can be useful if the buyer is only going to be acquiring part of the business or a particular subsidiary, or if you want to retain specific assets such as investment properties. And the good thing with demergers, you can normally do that with minimal or no tax implications at all. The most common tax implication is potential stamp duty charge, but the rate of stamp duty is only 0.5%. So ideally you do it with no tax leakage, but sometimes it can't be avoided. And finally, it might be that it's not necessarily a third party coming that's buying the shares. A company purchase of own shares could be done. So if you've got other shareholders that are going to continue and just one shareholder retiring, the company could simply buy back those shares. Those are automatically treated as income distributions. However, there is, provided you meet certain conditions, you could get that out as capital as well. And again, tax at 10% if you've got business asset disposal relief, or you've got management buyouts. Certainly that's quite common in the case of family takeovers if maybe the next generation is taking over. But I've definitely run out of time there. So if there's any further questions, don't hesitate to contact me.
Thanks, Nick. Can I
Sure.
seamlessly pass over to Bart?
Yeah.
Hey everybody, now we're going to talk a little bit about the legal. Everybody woke up this morning and said, you know what, I want to listen to an accountant, a corporate finance person, a lawyer, and an IFA. But so we're going to walk through a lot of things that happen here. Portfolio legal, we only do happy law, so we help people buy, sell their businesses, and make sure that they're protected, working in association with Jerome's on a lot of different deals. So Paul, can we move forward on this? We're going to talk today about the 4.5 Ps. So not only did you come here for 4 Ps, but you get an extra half. I'm BD Dalton. I'm a director at Portfolio Legal, and Robert Hankin, who's going to help us with the questions after this, is my business partner and the head of corporate finance, or the corporate side, and he's been part of 400 to 500 deals. He couldn't tell me exactly, but from large to small, multi-millions to hundreds of thousands. So we want to make sure that we can help you navigate things, but the biggest thing comes in planning, pre-planning, and Paul and Nick have both led to that. So I want to walk you through some things that we need to think about when we're going through. So the 4.5 Ps, here they are. First one's price, second one's pension, third one's property, fourth one's people, and the last one, which is a half, because it's not really a thing, but it is the thing that kills more deals than anything else, which is procrastination. So let's move through price first. So when we're looking at the issues that happen, we call them price chips. So somebody comes in and they tell Paul that they will buy your company for £5 million. We know that that's the starting price, because just like everything else, there's unrealistic expectations. The unrealistic expectations are you are selling your business. You want to sell it for the most amount of money that you possibly can, and that's the goal. But their goal when they're buying it from you is to buy it for as cheap as possible. If we start planning ahead of time, we can get rid of some of these flags that come up later on, and everybody's talked about this. Nick and Paul have already talked about it, but some of the flags that you're going to make sure that you go through and get structured and pull up are definitely things that, if we plan ahead of time, I'll walk you through some of those when we get to the other P's. The other one that Paul talked about was the structure, and Nick actually alluded to it. The structure of the deal. Is it earnout? Is it a lot of earnout? So are you going to get a lot of money up front or a little money up front and over time? And then the other thing that we've seen, especially through this interesting time that we've been through, is funding issues. So you get an offer, and then where's the money going to come from? So here's the issues. Let's look a little bit at the things that we can do to hopefully resolve the price problem. So if we move on to the next slide, the solutions. This is where Paul and your team at Jerem's and us at Portfolio Legal help you set realistic expectations for what you can get for the company. And then hopefully we can get better than that. But in the beginning, if we set it out realistically before we take it out to market, it's much better. Then we identify the potential price chips. So we start to look through the things that actually could affect what's there. Do you have a major provider that you haven't locked in on a good contract? Is your contract coming to an end with one of your major suppliers? How do we make sure that we can lock those things in legal terms so that when somebody's buying it, they can't say, well, you only have a year left on that contract, we'll pay you less. Early certainty on the price and structure. We want to make sure that we know how long the earnout is so we can have that negotiating point. Because at the beginning, when we've set the price, the big things that are going to come in later are all of these things that make it to the price points and start to take them away, take them down from that £5 million offer. And then exclusivity. So when somebody comes in and says, well, we'd like to buy your company, and Paul comes and we're starting to work together, we start to move forward and they say, well, we'll buy your company for the £5 million. And we have to turn around and say, to protect the deal, to make it move forward, we want to make sure that it's the shortest amount of time possible. So if we're working with you, then typically a portfolio, our overall goal is to make this 3 months or less for the exclusivity on that price of the £5 million. And then we want to know, show me the money. So this is identify how the buyer is actually going to fund the deal. So that's part of the thing that we want to know ahead of time. So that's price. Let's move on to the next one, property. We've seen this, especially in times like right now. What do people want to do with the property? So what is the intent of the property? Is it to keep it inside the business? Is it one of your family's assets and you're going to use this as part of your pension plan? If so, then how do we extract it out of the business? How does it depreciate or deplete the value? Are you in, like Paul talked about, is there a lease involved? Are there dilapidation costs? And when we're starting to look at things early, we want to make sure that we agree the key principles, the key items that are going to happen that are going to get us to that £5 million cost. We want to start to agree that in the heads of terms. So let's move on to some of the solutions that we could come up with, and we keep these as simple as possible. So we want to talk about what we're going to do with the property. This is one of the discussions that we need to have at the outset, is what are we going to do with it? Are we going to keep it in the family? Is it going with the business? Is it necessary for the continuation of the business? And what are they going to do with it? Are they going to need this for the factory, or are they just trying to consolidate? If we get into this, if there are any lease issues or if there are any dilapidation issues, we want to make sure this is pointed out ahead of time and not later on. And then we want to make sure that we involve the other parties. So involving the third parties, this is why you need a team working around you with Jerem's, with people like us at Portfolio. We want to make sure that your team is there working with you to identify and making sure we're talking to the property agents, you as the seller, the buyer, and making sure that we get these items pointed out way ahead of time. So let's move on to the next one, if we could, please. This is one of the ones that doesn't happen as much anymore, but it happened in some of our older, bigger deals, is you have non-standard pension schemes. So you have some of these QROPs, you have some of these other ones that are ESOPs and things that sit out there that just get in the way because people are scared of them. And the reason for that is that because especially with times like past in the tech bubble in 08, 09, and recently as we've gone through some fairly tumultuous markets, there are liabilities sitting inside of pension plans, especially some of the older companies. So the big acquirer concern here is deficit. So how are you going to fund that? So that can be a big, huge price chip if we don't get this right. It hasn't happened with that many of the deals recently that we've seen, but some of the bigger, older deals, it has definitely affected the price. So if we can move on to some of the solutions, because there's not a lot of these happening right now, we won't go too far into it, but make sure that you and your team have talked to the people that are providing the background, your trustees on your pension pots or your pension plans. Make sure that you have great record keeping. And this is one of those things where definitely with Jerem's and with us, we want to make sure that we've asked the questions ahead of time, because you'd rather have us ask you the question than the buyer, because the buyer's going to, if they're asking you questions, they're typically going to affect the price. And once again, involve third parties early. This is definitely one of those things. The earlier you talk to somebody, the earlier we can make sure we put those red flags up from our side and figure out how we're going to use them in the negotiation process. So if we move on to the next one, this is one of the trickiest ones that we've seen recently, especially when we're now going through furlough programs and things like this, that we want to figure out with your people. The fourth P there is your post-transaction. Who's staying in the business? Who are the key employees? Do we have employment contracts on them? Do we have ways to protect all of our assets and our intellectual property from these people going away? Are they going to take clients? Because if this has been a family business for years and years and years and we never needed employment contracts, and then you're one 6 months or a year away from sale and you start putting employment contracts in front of somebody, they're going to ask questions. So you want to make sure that we get ready to protect what the business looks like later, because that will affect the warranties and indemnities and the promises that you have to make to get the full amount of your £5 million or whatever you're selling your business for. The difficulty then becomes with, if you don't have conversations ahead of time, sometimes their people, the people on their side of the table are working against us instead of working with us if we don't start to talk to them early when it comes to property, when it comes to financial due diligence and legal due diligence, so that the sooner we can get to an agreement and a conversation, the better off we are overall when it comes to people. And then guess what? If you're selling your business, you don't want to, we definitely don't want to have one of those points where we're driving the business forward and then have to sell for either or less and hand them over some amazing business. So what we want to do is we want to start now, start talking to people about employment contracts, start talking to our providers, start making sure that the people that we work with, when it comes to our providers, our suppliers, things like that, we have good legal documentation protecting the business. And this is the first time this has come into it, but we try to, as soon as we've engaged somebody, get to that early side of the share purchase agreement. So this is where we've started to say, okay, what does the deal look like? What are you going to be asking us about? What information do we need to protect and look at to make sure that you're going to get the best deal? Good communication. So doesn't mean we have to reveal everything all at once, but we want to know what we have to reveal throughout the negotiation process. And this is where working with Paul and Nick and the team at Jerem's, that we can make sure that we are asking the right questions ahead of time. And the biggest thing, and the reason why we do a lot of deals with amazing people like Paul and Nick, is that it's a commercial approach. So everybody wants to get the deal done, because a broken deal does not help anybody. But then let's get to the very last P, the 4.5 P. So procrastination. So you keep putting it off. So the decision, let's leave those issues for later. Let's not worry about talking to the third parties. Guess what? The other side might be trying to delay it, either to find the funding, which we see at the end there, or they might be doing it because they know that there's something else that they're waiting for. So guess what? We've just come into an economic slowdown. I don't know if anybody else has been part of this, but guess what? They shut down factories and restaurants and everything else for the last 4 months. So if they knew something like that was going to happen, one, they have a great crystal ball, but two, they know that it will definitely affect the price, and they could come in and ask us for definitely go down from 5 million to 4 million or 3 million. But then the other thing is, sometimes they can't find the money. They thought they could, but then they ran into a situation like we just did, and we get to funding problems. So the 4.5 piece, we've got all of them there, and we're here to answer questions, but you really need to make sure, Paul, if we can go to the next slide, I think that's my last one. But the solutions we get here is, like we talked about with everything, let's just start early. Let's have great conversations. Let's make sure that you're engaged. We have good conversations with the other side, and that you allow us as your professional team to overall deal with that third party. So even if it's not us, which we hope it is, that we all have a great conversation, know what the game plan is, and we work our way out there together to make sure we get to that deal, because broken deals are not good for anybody.
Thanks, Mark. Appreciate it. Right, I think Nick Hathaway, you're going to take control of the screen. So.
Okay. Good morning, Nick Hathaway here from Jerem's Financial Planning. We're the independent financial advice arm of Jerem's, and I'm just going to briefly run through some of the financial planning opportunities to be mindful of when you're selling a business, and also what you should be aware of following sale. Like everyone else, conscious of time, so I'm going to get as much covered as possible. But if you've got any queries, feel free to leave a question or follow up with us afterwards. As Nick alluded to, the lifetime limit on business asset disposal relief was reduced from £10 million to £1 million earlier this year. As a result, extracting value from the business before sale can reduce the value on which capital gains tax is calculated, which is currently chargeable at 20% on anything above the £1 million limit. The options for extracting value out of a company are the same as when taking your regular drawings, that being salary, dividends, or eventual sale of the company. Each has its own benefits and drawbacks, and most tend to find that a combined approach is most suitable for them. Salary has the advantage of being tax deductible, thereby benefiting from 19% corporation tax relief. However, where certain thresholds are exceeded, income tax and both employer and employee national insurance may be payable. Dividends benefit from lower tax rates and the £2,000 0% dividend tax band, making this an attractive way to draw larger amounts. However, dividends are paid from post-tax profits and therefore suffer 19% corporation tax. The other method is to retain value within the company in the knowledge that on sale only 10% capital gains tax would be payable thanks to business asset disposal relief, which we've already covered. However, this means suffering corporation tax at 19%, as well as losing the flexibility to draw from the company on a regular basis. Also, as mentioned, 20% tax will be payable on any sale proceeds above £1 million. But there is another option, which is pension contributions. Pension contributions are a business expense and so benefit from corporation tax relief at 19%. This basically means the taxman is contributing to your retirement fund. Any investment growth is tax-free and not subject to income tax or capital gains tax within the pension wrapper. Up to £40,000 can be contributed annually, and unused allowance can be carried forward from up to 3 previous tax years. This means that potentially up to £160,000 can be paid in a single tax year where certain conditions are met, which can be a substantial tax saving over leaving it within the company. The pension can be accessed from age 55 with up to 25% of the value being completely tax-free. And if the funds that you hold within the pension aren't needed, they can be left to grow in a tax-free environment and will be exempt from inheritance tax up to the lifetime allowance, which is currently £1,073,100, which can then cascade down to the next generation and beyond. Where the pension holder dies before the age of 75, the funds can be taken by the recipient completely tax-free up to this limit. This is today's pension fund. In essence, it consists of 2 bank accounts. One is 25% of the overall value and is entirely tax-free. The other 75% is subject to income tax under the normal rules. When funds are taken from the tax-free side, as you can hopefully see there, a corresponding amount is crystallised from the taxable side and can be taken flexibly as income. Many clients don't need all their tax-free cash in one go, which allows them to flexibly phase the income they take while leaving the balance invested to grow tax-free. This can be an extremely tax efficient way of drawing income. Up to £12,500 can be taken as income from the taxable side with no tax payable, as this is within the personal allowance. A corresponding £4,167 can also be taken from the tax-free element of the pension. This generates £16,667 of income without any tax being payable whatsoever. Further income can then be drawn up to the basic rate threshold, which would give a further £37,500, with again a corresponding £12,500 tax-free. The result is a net total income of £59,167, on which just £7,500 of tax has been paid, which, as you can see, this is a highly tax efficient way of taking an income in retirement and can be drawn with complete flexibility as and when required. You might recall a government minister referring to pensioners purchasing Lamborghinis with their pension funds, although this isn't something that we'd recommend you do. That brings me on to the other major consideration when selling a business, which is inheritance tax. Proceeds from the sale of a business will eventually form part of an individual's estate and can create an IHT liability, which is chargeable at 40% on anything above the exempt nil rate bands. This is where business property relief, or BPR, comes in. BPR was originally designed to protect family-owned businesses from needing to be sold or broken up to fund IHT charges when the owner dies. Recent governments have used this relief to also encourage third-party investment in unlisted and smaller businesses, even where the investor isn't involved in the business itself. BPR qualifying shares can be passed on with no IHT, although the shares must be owned at death and the business must be trading, i.e. not investment based. To put that into context, I'd like to introduce you to Alan. Alan sold his business 2 years ago for £3 million. He invested £2 million of it to fund his retirement, and he would like to leave the remaining £1 million to his daughters when he passes away without them having to pay a large inheritance tax bill. Alan's shares in his business would have been expected to qualify for BPR, which means he could have left them to his daughters free from inheritance tax, providing he still owned the shares when he died. However, the cash he received from selling his business will be subject to inheritance tax because of the size of his estate, which means a tax charge of £400,000 on the £1 million left to his daughters. Typical inheritance tax planning measures can take up to 7 years to take full effect, which may not be suitable for everyone and would be ineffective if Alan died during that 7 years. However, if Alan were to reinvest the sale proceeds into a BPR qualifying investment within 3 years of selling his business, the relief would be retained and no IHT would be payable by his daughters. BPR qualifying investments are typically riskier than mainstream ones. AIM shares and enterprise investment schemes are some example of BPR eligible investments. However, this is where dedicated business property relief investments come in. We use a wide range of these from many different providers. However, Time Advance is an ideal example. These investments aim to qualify for the valuable relief of BPR while reducing the associated risk and preserving the original capital invested. Time have a 20-year track record and have deployed over £800 million on behalf of 7,000 investors. The target return after charges is 3 to 4.5% per year. The fund's intention is really to retain the value of your investment while qualifying for BPR rather than producing specific investment returns. It's just looking for cash returns, really. It's also worth noting that Time will only take their management fees once a return of 3.5% has been reached. The investment made has liquidity and can be accessed if you're later needing access to any or all of your funds, which makes it ideal as a holding account if your sale proceeds are intended to be reinvested into another business, and will ensure your funds can provide an income and remain IHT friendly until the next venture comes along. Time have established Elm Trading as the BPR qualifying company in which your investment will buy shares. Elm Trading invests in a diverse range of asset-backed investments and renewables, all chosen due to having a level of security, whether that's secured lending, strong revenue streams, or the range of government subsidies and feed-in tariffs, which the renewable energy investments, which you can hopefully see on the right, will benefit from. The effect of all this is to greatly reduce the risk that's being taken while also benefiting from a 40% tax saving thanks to BPR. So if you've recently sold a business or are thinking of doing so, considering the effect on your estate and inheritance tax liability could lead to a sizable tax saving and more of your hard-earned money being left to those you intended rather than the taxman. Now I'll pass you over for Q&A.
Thanks, Nick. Thanks everybody for participating. Sharon, I know we're tight on time. We may run over by a few minutes, so I apologise in advance. But Sharon, do you want to run through any questions that have come through while the webinar's been in progress?
Certainly, yeah. Thank you for submitting your questions. There is a bit of a common theme to some of the private questions that have been submitted. So I've consolidated those, and I'd like to start by asking, is there anything that that I should do to prepare my business for sale?
Yeah, I mean, I think if I can pick that one up, I mean, I think it's obviously a business dependent question. So we need to look at the business, but the answer is almost certainly yes. Now that might range from stuff that's at the complex end of the spectrum, which we've touched on during the webinar, which is things like maybe there's some assets that should be demerged from the business, or extracted, I should say, rather than demerged, because a demerger may or may not be the right route to go. But maybe some assets, perhaps a property, maybe you know, some division of the business which we don't see as being key to selling the business. It's maybe run by, I don't know, your wife or your son or your daughter, and that's really not your intention to dispose of that aspect of the business. So step one is look at what does the business look like that we're going to sell, and how do we best and most efficiently extract the bits of the business that don't, if you like, are not going to form part of the sale process. But I think another side of that is what can be done within the business itself. I mean, there's some fairly obvious things like, you know, if you're thinking of selling a business, now wouldn't be a good time to be investing in maybe a new product or a new service line or activity, maybe looking at some of the discretionary spend components. I'm not saying this with any kind of sneer in my voice, but clearly people do tuck away expenses that you know, may not necessarily be of a wholly and exclusive business nature. So that isn't a good thing to have come up during the due diligence process. So cleaning up the business, demerging the bits that are non-key, or extracting the bits that are non-key, and then just looking at the short to medium term strategy as to what new investment activities are going to take place are the three most obvious things, but there may be others.
Okay, thank you. Another question, is it more valuable to sell a company as a whole or in parts or divisions?
Okay, again, probably one for me, that one. Okay, the answer to that question is entirely dependent upon the business itself. So it's likely to be the whole, but in all honesty, we'd need to look at the trading results. I mean, businesses are typically bought on a multiple of their earnings as opposed to their asset value. There are lots of different ways of valuing a business, and in some instances the asset value may be the higher of the two, but that's more the exception than the rule. So typically we would need to look at that, and it's all part of that right at the very beginning, that planning stage is for us to look at it. If that were to come to pass, and I know that Nick Wright and I are working on one business where that would very definitely be the case. So we have looked at that and made a recommendation which the client is implementing on demerging certain aspects of the business before we then sell the part of the business that we're going to focus on. So that would be a case where the sum of the individual components is greater than the whole, but it isn't, there aren't any golden rules to that. It will be business dependent.
Okay, and another question was, how long does the whole process take typically?
I'm tempted to defer this off to one of my colleagues, but in my experience, I mean, let me try and keep the process moving forward. It's almost never less than 6 months from beginning to end, and in my experience it can be anywhere between 6 and 12 months. It shouldn't take any longer than 12, and if it does, deal fatigue starts to creep in, and then there's a risk that the whole thing may lose momentum. But you're looking at somewhere between 6 and 12 is the honest answer to that question. I'd love to promise everybody we can do it within 6, but the more realistic is somewhere between 6 and 12 months.
If I can add to that, Paul, as Bart said in relation to exclusivity, we want to keep it at 3 months or less. So the legal process should be the last 3 months maximum.
And that's really the fourth pillar on my process chart. That's when that occurs. So you're right, that stage of the process is typically locked into a period of exclusivity where we complete the due diligence and move into the legal documentation phase. And you're right, that process should take 3 months and no more. But that whole process from beginning to end is likely to be somewhere between 6 and 12. Sharon, do you want to cover off? Is there any more questions you want to cover up before we close out and thank everybody?
No, I think that's it. I think any outstanding questions we can go back privately to people.
Yeah, okay. I think people have our contact details, and this stuff's all going to go up on the website later anyway, so anybody can jump in and ask us questions independently. Well, that just leaves me to say thank you to the fine group of participants. Thank you all for your invaluable contribution this morning in terms of those of you who've made presentations. Thanks for everybody who jumped onto the webinar, and stay safe. Thank you, everybody.